ICAI students, let's revise AFM and AFM, Chapter 13, Business Valuation, Practical Question 13. Delta Limited's current financial year's income statement reports its net income as 15 lakhs. Delta's marginal tax rate is 40% and its interest expense for the year was 15 lakhs. The company has 1 crore of invested capital, of which 60% is debt. In addition, Delta Limited tries to maintain a weighted average cost of capital of 12.6%. Compute the operating income or EBIT earned by Delta in the current year. So, operating income or EBIT. We have net income as per the income statement, which is 15 lakhs, which is after adjusting the interest and then after taxes. So, the marginal tax rate is 40%. So, this represents 60%, which is after taxes. So, 15 lakh divided by 60% will give us the total taxable income. To arrive at the operating income or EBIT, we have to add back the interest portion. Now, we know the interest expense for the year is 15 lakhs. So, if we add back that to this 25 lakhs, will give us the EBIT, which is nothing but 40 lakhs in our case. Now, the second requirement is what is Delta's economic value added for the current year? For economic value added, so the EVA is nothing but NOPAT or net operating profit after tax minus capital charge. This NOPAT is operating income after tax or EBIT multiplied by 1 minus tax rate, and the capital charge is nothing but invested capital or the total capital multiplied by weighted average cost of capital. Now we know the operating income EBIT 40 lakh in our case, and we know the tax rate 40%, and the invested capital also is 1 crore, and the weighted average cost of capital is 12.6. So the answer is straightforward. 40 lakhs multiplied by 1 minus 40%, 0.4, minus this 12.6% multiplied by 1 crore will give us the economic value added. So economic value added, as we have previously discussed, is nothing but the extra value the firm is giving over and above its cost of capital. In this case, the cost of capital is 12,60,000 and the net operating profit is 24 lakh. So the company is giving extra value of 11,40,000 over and above its cost. Okay. The third requirement is Delta Limited has 2,50,000 equity shares outstanding. According to the EVA you computed in 2, how much can Delta pay in dividend per share before the value of the company would start to decrease? So they've given number of equity shareholders and dividend, whatever the economic value that can be distributed as dividend. So they have clearly told according to the EVA calculated in B in second point, how much Delta pay in dividend per share before the value of the company would start to decrease. So as of now, the company's value, the economic value is 11,40,000. Dividing it by the number of shares outstanding is 2,50,000 will give us 4.56. That is the value per share. So that can be distributed as dividend. And if Delta does not pay any dividend, what would you expect to happen to the company? If the company didn't pay the dividend, then obviously it will get reinvested in the business and it will add more value to the company, and the EBIT or the operating profit will increase because the company has enough excess funds to again put those funds in the operations and it can earn more money. So that's what I say also given. If Delta Limited does not pay a dividend, we would expect the value of the firm to increase because it will achieve higher growth, hence a higher level of EBIT, hence a higher level of EBIT. If EBIT is higher, then everything else remains equal, the value of the firm will increase. So this point is important. So keeping other things equal or keeping other things constant, that's an assumption, then only the value of firm will increase. That's it. Thank you.